Welcome, everyone, and thank you for joining us. I'm Emma Oakley, a co-head in our real estate sector group in the London office of Taylor Wessing. In more normal times, our international real estate team would this week be attending Expo Real in Munich, and hopefully would have been meeting with a number of you in the audience there during the course of this week. In lieu of being able to do that, we have instead planned on hosting a series of webinars and meetings over the next couple of weeks in order to bring together our international network of colleagues, clients, and intermediaries in the real estate industry. To kick things off this morning, we will be focusing on the impact of COVID-19 on the international real estate finance market. I'm joined by partners from a number of our European offices. We have banking and finance partners Gareth Lawson from London, Jens Wiesner from Hamburg, and Andrew Bebe from Amsterdam, and real estate and construction partner Peter Salt from Vienna. If you have any questions during the course of the discussion this morning, please do type those into the Q&A function on your screen, and we'll pick those up either during the course of the discussion or at the end as timing permits. So to go to the first question, what has been the impact of COVID and the related lockdowns on the real estate finance market in your respective jurisdiction? And what is the current market outlook for the next 6 to 12 months? And mixed in with that, it would be interesting to hear to what extent some sectors within your jurisdiction have fared better than others. And I think, Jens, if it's okay, we'll kick off with you on that question.
For sure, many thanks. Hi, everyone. Good morning. My name is Jens Wiesner. As already said, I'm a finance partner in Hamburg, focusing primarily on real estate finance transactions in all asset classes and representing banks, financial institutions, pensions funds, as well as sponsors and borrowers. So first, let's take a quick look back on how COVID affected the real estate finance market in Germany from the beginning of the year. After, let's say, a quite successful Q1, obviously, most of the market participants have been in some sort of status of shock, which means that at the beginning of COVID, a variety of deals have been put on hold or stalled or didn't proceed to closing, because most market participants were trying to figure out how deep the impacts would ultimately be on the real estate finance market and what consequences they should draw in terms of their investment strategies, and from a bank's or lender's perspective, what impacts this would have on existing loan agreements and as well as new loan agreements. If we try to separate the market into different asset classes, I think it makes sense basically just to give you a broad overview. I think that COVID has accelerated the structural change which has been in the real estate market for quite some time, meaning that in particular retail as well as shopping center financings have been under quite some stress. In particular, also, when you look at hotels, which were locked down and heavily impacted, these were obviously also in a dire situation since cash flows were drying out immensely during the lockdown period. On the other hand, if you look, for example, in asset classes like logistics, as well as residential areas, the impact of COVID has been very little, not to say accelerating investment in logistics, since due to remote ordering and limited access to open stores, people were going towards ordering their daily products online, meaning that in the logistics sector, they had a huge upside during the COVID-19. From my perspective, when you look at the office sector, it's quite unclear on how this will develop in the near future. The rents for offices, obviously due to long-term lease agreements, have been quite stable. However, in my point of view, it's quite unclear how this will develop in the near future, take into account that all of the large corporates have realized that remote working actually works. and that ultimately this might lead to a downsizing in leased office space. In particular, when you look at speculative development projects in office buildings, there is a reluctance currently, in my view, in the market to proceed on finances, at least in terms of the previously known LTC ratios. Lenders are quite reluctant to proceed on the pre-corona status in terms of the uncertainty, which will come down the road in the next, let's say, 2, 3, 4, or 5 years. When also taking a look at the current numbers, the German real estate finance market has proved to be quite robust. The Thomas Daily news update today morning just laid out that on the basis of current calculations, the REF market in Germany is only 3 billion short as compared to the very successful past year, which is basically an outcome of the very successful Q1 and the up-picking market in Q3 in the in after Corona and after lockdown.
Sorry, just trying to take myself off mute there. Thanks so much for that, Jens, appreciated. And Gareth, if you wouldn't mind going next, do you see any parallels in the UK market or any points of difference?
Yeah, I mean, I think what Jens has said is quite echoed for the UK market. The first quarter of 2020 was certainly a lot busier, I think reflecting probably quite a quiet Q4 of 2019 in the UK, where we had quite a lot of uncertainty off the back of Brexit and the general election. And I think there was quite a lot of positive sentiment at the start of the year that this was the chance to catch up. Of course, that's kind of all went on hold over the summer, and spent a significant period of time working through issues with lenders and with borrowers. I would say, however, that we've still been working, and certainly lenders have been working on deals throughout the lockdown. And those have been, for UK lenders, have been deals, or UK-based lenders have been deals both in the UK and in continental Europe as well. So I think there's the market sentiment still there to do deals where the deal is right. And in terms of the sectors, I guess the sectors Jens mentioned, in terms of those most affected and those probably experiencing an uptick, have been equivalent in the UK. Hotels, retail, particularly badly affected. The logistics, industrial sectors experiencing a continuing growth. I think there was already interest in them, as Jens alludes to. It's more a case of accelerating those structural changes than this is completely new. So many people realise logistics are where to be. I'd say that the thing I probably add, and Jens can maybe speak to the point in terms of Germany, is that probably interest in the bed sector, if we exclude kind of hotels from that, but student accommodation and PRS. And there's still a positive sentiment around investing in those sectors, probably tempered by a little bit of uncertainty in the student accommodation sector around international students. But I think people are still positive as to that as an asset class in which to invest. And then we kind of come to the office sector. And I know we've got a webinar actually next week, which hopefully the participants can see on their screen, the opportunity to register for that, where we will look in more detail at the future of the office sector. I think there's probably going to be a consideration as to how people use their offices. As Jens says, the payment of rent for office occupiers has held up. It's looking at some figures that Grefka released yesterday around rental collections, and certainly the office sector is above 90% for June. So I guess there's positive sentiment there in terms of the long-term lettings, but people have to consider how people are using offices, whether tenants are more likely to exercise breaks, or as we saw in the case of Google not too long ago, taking up extra space close to their own offices. So people approach it in different ways. I think in terms of the market outlook for the next 6 to 12 months, it's, I guess, as it has been all year, it's a bit uncertain, because we'll look at, will there be a second, or we're kind of in the middle of a second wave, so how do people experience that? What impact does it have on whether people have to go into a further lockdown, and whether that then impacts into economic uncertainty? And that's before you kind of throw in Brexit and the US election into the mix. So we've got kind of quite a potent mix of things ahead. I'd say my impression sitting here is that people are still willing to lend where the asset works, and the sponsor and the business plan will work together. But it's a case of working through all those metrics before we can decide whether it's right to lend. I guess Andre and Peter can speak to whether that's sort of similar experience in their particular markets.
Great, thank you, Gareth. Andre, should we come to you next in relation to the Netherlands and what your experience has been there?
Yes, absolutely. Thank you, Emma. My name is Andre Babby. I'm the banking and finance partner in the Amsterdam office of Taylor Wessing. And turning to the Netherlands, I think the current situation in the Netherlands is largely comparable to that in the German market and in the UK market, as described by Jens and Gareth. The Dutch property market has been clearly affected by the crisis. What we see is that up to now, the 2020 transaction volumes are approximately 15 to 16% below the 2019 level. The hotel and retail sectors have been hugely affected by the pandemic, while the logistical and the residential sectors are doing reasonably well. The majority of logistical operations are continuing as normal, and the vacancy rates in the logistics sector remains low, while the residential market is generally seen as a safe and reliable harbor in these uncertain times. The Dutch offices sector is, despite some consequences of the lockdown, also doing reasonably well, with deals being closed during the crisis. And more generally, the Dutch office market appears to be more resistant to the current crisis than before to the credit crisis in 2008, with the office vacancy levels continuing to be quite limited, with the vacancy rate in the major Dutch cities remaining below 10%. And I think in terms of the expectations for the next 6 to 12 months, I think there is still a lot of concern about the second wave and about the further lockdown measures which may be introduced by the government. So we continue to be in a very uncertain situation. So the market participants are very cautious about what's going to happen.
Thank you for that, Andre. That's really helpful. And Peter, just to conclude with you on this question, obviously there's been quite a lot of overlap, I think, in the other jurisdictions' experience. What are your views on the CE market? How has that fared?
Yes, thank you. Good morning. I'm Peter Salt. I'm the head of real estate of Taylor Wessing's Vienna office. I'm part of the CE real estate group, and obviously I also work quite closely with the finance partners in the region on leverage transactions in this area. Since we are speaking about a region of composed of markets of different maturity, I guess it's a bit different when you look at Austria and when you look at the other countries in the region. In Austria, surprisingly, in various market segments, we have had very little impact of the COVID crisis so far, as the real estate market itself is concerned. Here, one can see that especially in the residential markets, prices are stable, not to say they have continued the upwards trend that we have seen in the last couple of years. A lot of ongoing transactions that were pending when the crisis erupted in March got closed. But obviously, and the market also has become more attractive for international investors that have not looked at Austria so far. But obviously, in the non-residential segments, the picture is definitely more diverse. As far as the sectors are concerned, I can only echo what has been said so far for the other markets. We see logistics and obviously residential project at the stable to positive end of the spectrum. With the office market, we have a lot of uncertainties how future strategies of tenants will develop, whether they will need less space because of home office, whether they will need more and different space because of the necessity to spread people out when they are at the office, and everything concerning retail and leisure projects of any kind. Obviously, the market has stopped to a large extent, both in terms of transactions and both in terms of leverage. And in the other markets that I want to address to a certain extent here, which are the Czech Republic and Poland, you obviously see a bit of a different picture because the residential market and the development of projects in that area is less significant and less dynamic than we have in Austria. So that means non-residential commercial projects are more important, and they obviously, and the risk assessment of these countries by investors and financial institutions is also quite different when you compare it to a market like Austria. So there definitely transactions have slowed down, and also the finance market has stopped to see how things may develop, and that certainly has led to a significant slowdown both in the area of project development and financing pipeline. And all of this combined obviously with the uncertainties about the developments that we may face in the upcoming month over the winter.
Thank you, Peter. So I think if we move on to the next question, clearly and very unfortunately, a number of borrowers have over the last few months found it difficult to meet their loan commitments as a result of the financial pressures coming out of COVID-19. So I'd be interested to hear on how lenders in each of your jurisdictions have approached some of those issues, and whether there are any common themes that you've noticed as to how lenders have been approaching requests for waivers, for example. To change up the order slightly, Gareth, I think I'll come to you first on that one, please.
Yeah, thank you, Emma. Dami, I guess certainly the initial period of lockdown, March through to June, July, I'd say we were very busy looking with both borrowers and lenders at potential breaches and waivers requested, and those probably range from the most obvious, an inability to pay or service your debt, through to potential financial covenant breaches, either looking backwards at the rents collected or forwards based on tenants that were sitting in arrears and therefore excluded from financial covenants. Not so much LTV breaches, as I imagine not many valuations were able to be undertaken during that initial period. And then maybe less extreme end of the spectrum would be provisions around delivery of financial statements or representations around no default or no material adverse effect. And I think there we saw kind of a differing range of responses from lenders. So where the requests were around is a material adverse effect occurring, of course, lenders typically generally fairly cautious about calling that as an event of default. And we certainly saw a lot of, I would say, comfort being given by lenders to their borrowers that they wouldn't look to call on that basis. And probably standing alongside that, the regulator in the UK did issue some guidance to, and this wasn't a direction as such, but certainly guidance that lenders should be very mindful of the COVID situation in considering how they were dealing with their borrowers. So generally speaking, we didn't necessarily see a particular appetite on lenders' part to waive breaches there, because I think the feeling was there really wasn't something that they would look to enforce on, and that the borrowers really could take some comfort from that. At the kind of middle end of the spectrum, the breach of the financial covenants, there, of course, I think it's far harder to say this hasn't happened. You're delivering compliance certificates evidencing what your cover is, or debt service cover is, or the like. And in those circumstances, that's a harder thing for a lender to say, don't worry about. And so there, I think waivers were generally forthcoming from most lenders, and we'll kind of come on to how those have been approached at the moment. The kind of last part, the inability to service debt, I think that's largely differed from sector to sector. So I think probably in the hotel sector, we've seen a greater willingness to waive amortization or interest payment for a series or a period of time, as I think lenders have acknowledged that the hotel sector in particular was really struggling to collect or get income in, and therefore service their debt. And those were areas where people, I think, were comfortable giving probably more support than in, say, the office sector, where I think the feeling was rent should be being paid, so you should still be able to service debt. And that then kind of comes on to how it's been approached. That's between lenders and borrowers. And I would say, generally speaking, it comes down to communication between the counterparties. So what a lender doesn't want to is the day on which the compliance certificate's due, or the day on which interest is due to be paid, a call from the borrower saying we're in breach and can we deal with it now. The clearer the lines of communication and the more support, I guess, sponsors are willing to give, our experience is the more mindful the lenders were of their situation. And that, I think, will be a consistent theme going forward. Of course, the longer protections for tenants, for example, goes on in the UK, and therefore perhaps has an impact on rental collection. Query how much support lenders can continue to give if it starts to put drags on their own capital requirements. So that will become more challenging. I think you'll see a more, I suspect, sector divided approach becoming more apparent. So those sectors where people are more confident in the situation may find it easier to get short-term waivers, but harder to argue that they should be given longer, because in theory those areas should be performing well. I think there'll also be, as there always is at the outset, but increasingly focus on how much support sponsors are willing to put into transactions, and indeed the quality of the underlying asset and business plan. Do lenders have the confidence that this is a short-term blip, which the borrower is in just as good a position as anyone else to resolve, or is it more an underlying structural issue with the asset or the business plan, in which case they might have to consider a different approach. But I think that the takeaway is that the approach, certainly for the last 6 months or so, has been to look to collaborate and work as closely together as possible to support borrowers through what is obviously a challenging period, and that's been kind of been underpinned by the communication between the parties. Maybe Jens just speak as to whether he's had a similar experience in Germany, as I suspect the markets are relatively aligned there.
Thank you, Gareth. Yes, I do agree. I think it has proven fruitful that borrowers and lenders have been working alongside in close communication channels in order to evaluate the exact position of the financed assets. And it has been proven extremely helpful that most borrowers were trying to seek compromises throughout the distress period in order to find a suitable solution which would work for the lenders as well as for the borrowers in challenging times, which basically affect everyone. And if I may draw a comparison towards the Lehman crisis, I think it has been proven very, very useful that the covenants and the leverages which we have seen in the past years were completely different to what we have seen in terms of financing provided in the Lehman crisis, which means that the borrowers still have a huge stake in the assets. They don't think that they have lost the equity yet, meaning they're interested in finding a suitable solution. When coming back to the initial question, asking whether there have been common approaches on how to address these issues, in my view, these were always very tailor-made, individual, on a case-by-case basis, because it's quite difficult in terms, when looking at finance assets, how these were affected. For example, in portfolio financing, you might have some assets which might make up for the loss or shortfall in rental collections. If you have a single asset financed, for example, a hotel in a PropCo-OpCo structure, obviously there needs to be different mechanism to be implemented in order to procure that the financing can proceed. As a general connotation, the Association of Covered Bond Lending Banks, Verband Deutscher Pfandbriefbanken, has issued guidelines on suggestions on how lenders could approach situations where the borrower isn't able to either pay amortization or even interest, giving some guidelines on how this should be addressed. Apologies. However, these guidelines is some sort of a voluntary arrangement, and not all Pfandbriefbanks have ratified the same. So I've seen a variety of circumstances where the lenders were willing to postpone amortization and also postpone calculation of cash flow covenants, in particular DSCR, ISCR, or debt yield for a certain period of time, provided that prior to the crisis, the loan has not been in default. So basically, when coming back to what Gareth just said, the lenders took a view that it is that the current crisis is something which only can be mastered if people work hand in hand together, and they were to some extent fairly lenient on granting waivers for a limited period of time, with the view that things will pick up and be in a quasi-normal state in a certain period, meaning that there have been waivers on amortization, for example, for 6-month periods, and also waivers in terms of cash flow covenants, or even some resets or covenant recalculations in this respect. However, what I have not seen is that lenders were willing to waive interest payments, and in order to also take a view from the borrower end, the borrowers were willing to cooperate, for example, in instances where the sponsors were willing to provide additional sureties or guarantees to make up for interest shortfall for a certain period of time, giving the lenders more comfort that the interim period will be covered, and that when things get back to a more normal state, that the whole financing structure will be stable again. Taking an outlook, I think the uncertainty, which already has been addressed in the first panel round, is that there might be a second wave, and it's still to see how cash flows will develop. the valuations in terms of the LTV for the time being are still quite stable when you look at the market value. So I don't see that much impact on the valuation LTV end of real estate financing, but rather on the cash flow end. And I think this is the highest concern for the lenders in the current state, to closely evaluate, even in shorter terms than originally envisaged in the finance documents, to get a proper view on how rental collections income is going to develop on maybe a bi-weekly or monthly basis, as compared to where lenders were willing to accept reporting in longer terms.
Thanks for that, Jens. And Peter, as you mentioned earlier, you're operating it perhaps in a slightly different market to the others in terms of its maturity. In terms of the approach you've seen lenders take in the CEE, could you share with us your views on that, please?
Yeah, I mean, I think a lot depends on the reaction of local governments and legislators, whether to support the borrowing side with regulatory measures of a mandatory nature. So obviously in Austria, there's a distinction. We have had a statutory moratorium for consumer loans and for loans of small enterprises for a couple of months, which has been extended until the end of October, is already back in the spring. So for the first phase that we have seen, this obviously has helped the borrowers, and there was not much the lenders could do about it. In the market segments that were not covered by this moratorium, I think a lot, again, depended, like in the other jurisdiction, on the willingness of borrowers and lenders to work together. And I think what we've seen in the market generally is that in the area of existing loans, there was a lot of readiness of lenders to agree to extensions of final maturity and suspension of debt service for a period of, say, 6 months. Obviously, always, if the loan wasn't in default at the time the crisis erupted. And here, I think we've also seen quite frequently a willingness also to suspend interest payments. What has been affected naturally was the availability of commitments for new financing, especially speculative short-term financing has been stopped on a broad basis by banks, simply because of the uncertainty how markets will develop. And again, the uncertainties that lie ahead of us now for the next 6 to 12 months, depending on how the crisis will further develop. I think that's the second question that we have, especially because a lot of these statutory impacts on the markets are to run out. Similar observations are true for the Czech Republic and for Poland, as we have seen, and I've come across the statistics for the Czech market that there 10% of borrowers have opted to exercise the option to defer payments if it was available to them. Of these, again, were 65% consumer loans and 25% mortgage loans. So you could see that this was obviously something that was a tool that helped in the residential market, but obviously for the commercial market, the observations are the same. And I think the sentiment that the market assessment that we hear from Poland is very similar. That there is obviously willingness and recognition of the necessity to work together in the current situation, but clearly increased equity requirements and lower percentage of LTV evaluations, and also shortening of credit lines generally. So, I can, to a large extent, echo what has been said about the other jurisdictions with different flavors.
Thanks for that, Peter. And interesting to hear that there have in some cases been statutory intervention on behalf of borrowers by the relevant authorities, because I don't think that necessarily has been the case, certainly in the UK, whereas there has been on the tenant side, which we'll come on to shortly. Before we do that, and Andre, perhaps we can just conclude on this question and your views from the Netherlands, please.
Yeah, thank you. In terms of government intervention, there have been no measures adopted by the Dutch government to directly support the real estate finance borrowers during the pandemic. However, the Dutch government has imposed several measures to support the Dutch economy in general, including support for jobs and income, and assistance to small and medium-sized businesses. And these measures have positive effects on the Dutch economy in general, and on obviously some of the tenants, and therefore indirectly they also benefit the borrowers. And what we see in the Dutch market is that the Dutch lenders have become very careful with requests for new financings, especially from new clients, while at the same time they try to keep the relationships with the existing clients whom they know well. And they continue to reassess the credit risks, paying particular attention to the sectors which have been mostly affected by the pandemic. But at the same time, they are increasingly more focused on dealing with their own internal issues caused by the pandemic and the lockdown. And in terms of approaches to waivers, what we see is that the Dutch lenders are quite cooperative, and they are often prepared to think together with the borrowers and to delay the amortization payments, although they are very reluctant to altogether waive any amortization or interest payments.
Great, thank you for that. So moving on to the next question, which is a related one. So where there have been government support programs or possibly also tenant protections in place in your jurisdiction, are these now ending? Is there scope that they may be extended? I appreciate none of us have a crystal ball, but what's the feeling in the market as to whether they will be extended? And to what extent do you expect a continuing impact on the ref market from that? On this one, Peter, perhaps would you come to you on that first, please?
Yes, I mean, we've seen a variety of tools employed and a variety of timing introduced by legislators and governments for these programs. You know, just to give you a flavor, in Austria, we've had a law restricting the termination of tenants of residential flats or houses for COVID-related default with the payment of rent. This will run out in December 2020, January 21, with an extended grace period for them to catch up with their payments. So this will affect the market for some time, especially also on the cash flow side for owners and landlords. We have had an insolvency stay for a couple of months, which is about to run out. We have this residential credit moratorium that I spoke about before, and we had a number of direct subsidy and government credit guarantee programs that were available and are still made available as the economic situation develops and as certain sectors are impacted. So we've seen the strategy to employ such schemes for a limited period of time, but I think with the situation that we're facing right now, that numbers are going up. I wouldn't exclude that some of those measures maybe fine-tuned, reshaped, but again either extended or reintroduced. And I think we have seen that this has also given some support and some stability to the real estate finance market. as far as the willingness to accept rescheduling of payments has been concerned. The interesting thing is that in the Czech Republic, that is now again running through a difficult second period after the early lockdown in spring. Most of these protection programs, as far as the situation is right now, have run out. So the insolvency stay, the loan moratorium, the tenant protection, all of those measures were introduced there as well. We have no indication that this is about to be reintroduced or extended. But for me, the interesting question is, when do governments see a necessity to get involved here again, and whether this will happen and how this may impact and support the market? I guess that's the million-dollar question that we are facing right now, all of us.
Yeah, agree, Peter. Andre, on the Netherlands, could you run us through some of the measures there and sort of how long they're set to continue for?
Yes, absolutely, Emma. In the Netherlands, the Dutch government has not adopted any measures affecting the Dutch lease agreements. Instead, the government left it to landlords and tenants to negotiate and agree whether a temporary delay or a reduction of lease payments is appropriate and acceptable to the parties. However, the Dutch government, as I previously mentioned, has adopted several protective measures to help companies affected by the virus outbreak and to mitigate the risk for the Dutch economy. Some of those measures are focused on relief for employers, such as temporary allowance for labor costs, while other measures are meant to support companies and relate to damage compensation, expanding government guarantee schemes, offering bridge loans, and some tax reliefs. But although I think the Dutch government support measures are helpful in general, I do not believe they have had a huge impact on the Dutch real estate finance market. I think what we see is that both sponsors and lenders, they continue to look at the fundamental risks and uncertainties caused by the pandemic and the lockdown, and clearly try to stay away from the mostly affected sectors while continuing to do deals in the less affected sectors.
Thank you for that, Andre. Jens, perhaps we can come to you next on this question, please.
For sure, many thanks. When you look at the German governmental state aid programs, the first thing you will note is that these are not directly designed to assist non-recourse SPV structures and sponsors to protect their equity, meaning that if you take a look at a typical financing structure where you will have an SPV, which is the owner, and then leasing out the real estate to a third party, these entities, generally speaking, are not eligible to apply for a specific state aid. The rationale is that the state aid has been designed to give relief to corporations and their employees, meaning that as a prerequisite for an application, you need to at least have some employees, which is not the case in the majority of real estate financing where you have an SPV structure. Usually it's also prohibited actually that these SPVs shall have employees. There is a small carve-out. There might be situations where SPVs might be eligible to apply for state aid, very limited. This might be the case, for example, if you look at a hotel financing where you have a PropCo-OpCo structure and the OpCo does have employees, there might be state aid available to the OpCo, which could then on-lend the funds to the PropCo. In some instance, for example, if you take at the financing of shopping centers, you can argue that there are lots of employees attached to that, for example, center management, asset management, property management, which might give you eligibility for state aid programs. However, generally speaking, these state aid programs were not directly available to real estate financing SPVs. However, in my view, the real estate finance market indirectly had a benefit from these state aid programs, since large corporates were eligible to apply for these, and being tenants in a variety of office buildings, this granted them sufficient liquidity to procure payments of financial indebtedness during the COVID crisis. Taking a look at tenant protections, for example, there were certain tenant protections available to residential and also to some corporate tenants available in Germany. However, you might have seen it in the press. Some larger corporates tried to pull the trigger on tenant protections and said that they are not going to pay rent in for a period 1, 2, 3, whatever month. The public outcry has been quite enormous, keeping in mind the liquidity reserves. So the tenant protections available, I think they might have been used in the residential sector on a case-by-case basis for individual persons, not so much in the commercial real estate area. A third part of the relief program in Germany was a stay of the insolvency proceedings, or not really a stay of the insolvency proceedings, but more lenient requirements when entities were required to file for insolvency, subject to certain carve-outs, meaning that they were not in a status of over-indebtedness or illiquidity by beginning of the year and so forth. So I think this has given some leeway to SPVs in terms of securing further liquidity during the crisis. These programs, or the insolvency stay, has been prolonged for some extent, but in my point of view, the variety of measures granting indirect liquidity to the market, and hence also giving liquidity to tenants, which in turn may then be able to provide the debt service to the lenders, have been proven quite fruitful for the time being. I don't see a huge impact for these state aid programs running out from my perspective, keeping in mind that there might be a second wave. No one knows what's impact gonna be there. But for the time being, I would assume that since the German market again has been proven quite robust, there won't be such a huge impact when these programs ultimately run out.
Great, thank you, Jens. And Gareth, perhaps before I come to you, I could run through some of the tenant protections that have been introduced here in the UK. So unlike with borrowers, we have had a number of direct measures introduced by the government benefiting tenants. The primary one of these has been to prevent landlords from exercising their right of forfeiture of leases for non-payment of rents, which has been something which has really bound landlords' hands to some extent in terms of enforcement. Coupled with that, it's also now more difficult for landlords to exercise their right to seize goods on tenants' premises, again for non-payment of rent. And the way that works is originally landlords only needed to demonstrate 7 days of unpaid rents. That was increased to 90 and then subsequently to 189, which effectively prevents landlords from exercising that right for arrears that have accrued over the last few months during the lockdown period. And the final measure, which has been introduced to benefit tenants, is in relation of statutory demands and winding up petitions, which landlords now aren't able to rely on where a tenant is in financial difficulties due to COVID-19. So it is still possible for landlords to rely on that right to present a winding up petition where it can demonstrate insolvency, but they have to also be able to show that the tenant's position hasn't been impacted by COVID-19, which actually can be quite difficult to do in terms of the access landlords would need to the tenant's financial information in order to establish that. All of those are temporary measures. When they were initially introduced, they were all intended to run out during the course of the summer months, but they have subsequently now been extended until the end of the year. And I think, as Jens was mentioning, in the Germany, there has been some public outcry in some cases where tenants have not paid rents, even though, on paper they really should have been able to do so, and their sector hasn't been impacted by the crisis. But notwithstanding that, they've almost, it's arguable, taken advantage of these package of measures because they knew that for the short term there's very little that landlords can do about it. So there has been some public reaction to that. But conversely, for those tenants in the harder hit sectors who genuinely have been struggling over the last few months and will continue to do so, I think an issue with the package of measures we have in the UK is that if they come to an end at the end of this year as intended, it creates a bit of a cliff edge. So what we don't have in the UK, unlike Peter mentioned for some of the CEE countries, is any sort of grace period for tenants to be able to repay any of the rent that has accrued over the last few months. So while all the measures have been helpful in the short term, in the longer term, we do expect to see tenants getting into potentially some difficulties when the measures do eventually come to an end. Final thought before passing to you, Gareth, is that there was speculation that our government might perhaps take a more nuanced approach to the measures and say, for example, extend the restriction on forfeiture in perhaps the hospitality and retail sectors only. They didn't take that opportunity. So at the moment, all of those measures apply across the board, even to those sectors like logistics, which have been performing quite well, notwithstanding the pandemic. But that's it really in terms of recap on the tenant measures, and then I'll hand over to you, Gareth, for what impact that's had on the UK ref market.
So thank you, Emma, because I think that very clearly sets out where the position was with the tenants, and of course what that really means is that landlords, and then by extension lenders to the landlords, have been asked to effectively support the businesses of the tenants who are unable to pay. And whilst there's been good rent collection in certain sectors and tenants have continued to pay where they can, in I would say the majority of cases, clearly there are, as you alluded to and Jens alluded to, situations where institute or corporates have sought to maintain cash and therefore take advantage of the requirement or the protections that have been afforded to them. And so I suppose that has impacted on the ability on borrowers to service their loans. And of course that's coloured some of the lenders thinking their dealings with the landlords, i.e. they've been put in a rather difficult position whereby they can't take action to get rents in from their tenants, even if their tenants are able to pay. And so the lenders had to be quite mindful of that when considering what's going to happen. As you say, there would have been a cliff edge at the end of September. That position has now been extended out, but we still have that kind of to come in sectors where tenants have continued to pay rent. Perhaps that's less of a concern where they haven't, and maybe those are sectors where lenders have been asked to give more in terms of waivers or waiving indeed serviceability of debt. Those will be more challenging, I think, as to no doubt there will need to be some arrangements between the tenants and the landlords to deal with those large lump sums that would otherwise fall due at the end of the moratorium. And lenders will in turn have to be asked to support their borrowers' positions. So I think again it will come down to communication, that lenders and borrowers will need to be closely communicating and trying to align as far as possible in terms of what the borrower then agrees with their tenants for repayment of those back rents. So there's going to be a lot of work to do, as you say. There was some hope that there'd be a more nuanced approach taken, and certainly that was something that the British Federation and CREF gives the Commercial Real Estate Commercial Real Estate Finance Council, both in support of. Those haven't come to pass. Question, I guess, would be when we come to the end of the latest set of measures, will we find ourselves in just a further extension, which I think would be a little bit blunt, or will we come to something more nuanced, which, if you appropriate, depending on where we are in terms of second waves for the lockdowns and the local lockdowns and the like. So, I think ultimately at the moment, quite a lot of pressure has been put on the real estate finance market to support the wider economic endeavours of the government, and there needs to be a bit of recognition that can't go on ad infinitum, but there needs to be some plan put in place. So when we're coming to the end of what is potentially a cliff edge, looks like government might need to consider striking a deal, which of course can be applied to plenty of other situations that we find ourselves in the UK. So we're quite familiar with cliff edges, unfortunately. Let's see where we get to on this one.
Great, thanks, Gareth. We've got just under 5 minutes left, so perhaps to wrap up, we could have a thought or two from each of you as to, aside from COVID-19, what you think the big issues are that will be facing lenders and their borrowers over the course of the next 12 months. And Gareth, perhaps we'll start with you on that one, please.
Yeah, probably in a word, LIBOR, or the replacement of LIBOR, and conscious we're short on time, and this is probably something we could spend an hour on easily and more. But in very short, the intention is that LIBOR is unlikely to be available beyond the end of 2021, and therefore certainly the pressure in the UK is for market participants to find an alternative to LIBOR. There have been various working groups set up with the progress on that was pretty slow until really over the summer, and so there was some push at the beginning of lockdowns to try and push out the periods within which people would like to see replacements implemented. That hasn't been particularly well received and hasn't been accepted by regulators. So we continue apace with this. I think momentum's now picked up in the market. Certainly the working group on risk-free rates in the UK has come out and recommended a compounded SONIA as kind of what it sees as the preferable rate, and has provided guidance now and recommendations as to standard market conventions. So I think the hope is that this will enable market participants to start to come to an agreement as to how they, and clearly each individual lender will need to work through what's right for them. But generally speaking, I think there's some hope that the market is now coming to an aligned position as far as possible. And therefore, I think that we'll see a significant portion of next year given over to dealing with amendments that need to be made to loans to switch to an alternative rate than LIBOR, but by the same token, I hope that the market will provide some relatively standardized approach that market participants can look to pick up, rather than every individual lender having to be a leader in their particular markets. We can obviously talk about that more, and I think we're very happy to speak to people, lenders individually, as to particular concerns around LIBOR, if that's helpful.
Thanks, Gareth. Peter, over to you next. What are your views on the big issues over the next 12 months?
Well, I want to highlight a few aspects quickly. I think certainly the introduction of DAC 6 and its implementation by both banking institutions and advisors like ourselves is one of the big question marks, and how this attempt to also restrict certain lawful or permitted structures with unwelcome tax effects may affect the project pipeline or project structures. I think that's one of the big question marks across jurisdictions. And two maybe industry-specific aspects that I wanted to mention for Austria is the expected reform of the condominium ownership regulations, which obviously would set the flexibility or the boundaries of the ability to develop residential properties and sell off apartments to investors or users. Then we will see how this will maybe create additional movement in the market in addition to everything else that is happening. And a similar initiative in the Czech Republic, there was a new building act adopted prior to COVID, which sets the conditions for proceedings to obtain a building permit, which was supposed to enter into force in 2021, and that has been pushed back to 2023. So that's obviously a big game changer in terms of anticipated rules for project development in that country. So I think these are the specific issues that we are faced with in the various jurisdictions that we cover. And certainly this will also require further analysis as we go down the road and try to help clients to develop projects and get them financed eventually.
Great, thanks, Peter. And Andre, coming to you next. I appreciate we're slightly over, but if we just wrap on this question, it'd be interesting to hear your views, please.
Yes, thank you, Emma. In the Netherlands, I think the already mentioned items like a replacement of LIBOR, introduction of DAC 6, but also the Brexit, they continue to draw a lot of attention from the market participants. And on top of that, in terms of kind of more Dutch specific items, I think it's good to mention that we have two new pieces of legislation which will be particularly relevant for the lenders. The first one is the new legislation on the new Dutch restructuring mechanism, which is comparable to the UK scheme of arrangements or the US Chapter 11 procedure. It's called the Dutch Confirmation of Private Restructuring Plans, or the VOA in Dutch. This bill has been adopted by the lower chamber of the Dutch Parliament on the 26th of May and is expected to be adopted by the upper chamber of the Dutch Parliament today. And then hopefully it will enter into force very quickly. And under this bill, we will have in the Netherlands an effective and flexible pre-insolvency mechanism to restructure viable businesses and to prevent their bankruptcies. A Dutch company facing difficulties will be able to offer a restructuring plan to all or some of its creditors and shareholders. And if certain requirements are met, that restructuring plan will be approved by the Dutch court, which will make it binding on all parties, including the non-consenting creditors. So it's something we have been really looking towards too. And another pending legislation is the bill submitted to the Dutch House of Representatives, which prohibits restrictions on transferability and pledgeability of receivables for financing purposes. And this will extend the asset base that can be transferred or pledged to lenders, which is expected to increase the credit potential of the Dutch companies.
Thanks, Andre. And Jens, over to you. Are there any similar themes in the German market or new legislation that's set to come in that you think will have a significant impact?
Yeah, thanks, Emma. To wrap this up, the observation is that obviously Brexit is still looming, and this is an issue which everyone needs to get comfortable with the one way or the other, keeping in mind that there might or might not be a contractual a contract between Great Britain and the European Union. Aside from that, what is currently being discussed is that there are in certain areas, limitations of the increase of rent for residential properties have been implemented. And obviously there are a variety of issues around that, since obviously investors were looking to acquire under-rented residential portfolios and then capex them up a tiny bit in order to have a higher revenue. There are legal discussions around whether or not this can actually legally be set by the relevant local authorities. So this is something which investors will have to keep in mind when they take a look at the residential market. However, in the past, it has been discussed, and it, in my view, hasn't been a huge inhibitor of investors seeking to invest in residential properties, which is still a very, very, very robust investment, at least from my point of view. In terms of legal issues, not so much legal. There might be some situations where banks will be seeking to see more equity, but this is more a factual commercial point and not so much a legal point. So other than that, beyond what has been already pointed out by Andre, for example, there's nothing particularly noteworthy which I would expect to come up in the upcoming 12 months from a legal point of view.
Thanks so much. So thank you everyone for joining us today. I hope you found that an interesting hour, and thank you to each of the presenters. And obviously, if you have any follow-up questions, either about the impact of COVID-19 or any of those changes that the panelists just mentioned there, please do feel free to reach out either to your regular TW contact or to any of the presenters today. Thank you so much, and enjoy the rest of your day.